As the financial industry's love affair with BRICS currencies begins to wane, we've seen the emergence of a new currency acronym, BIITS, meaning Brazil, India, Indonesia, Turkey and South Africa. Deanie Haugaard Jensen is on the phone with me now from Nordea to discuss this diverging trend amongst EM currencies. Deanie, who within this fragile five would you say is most at risk? Will political uncertainty in Brazil, for example, drag the real into a currency crisis? Or could India's current account deficit place the rupee in the most danger?
Well, first of all, in my view, all of these currencies are vulnerable for another emerging market sell-off round. The underlying problems which made them vulnerable in the first place during May and then again in August when things really picked up in the market, these problems are still the same. The 5 countries all post current account deficit ranging from a high of 7% of GDP in Turkey and South Africa to somewhat smaller deficit of 3% in Indonesia and Brazil. So, and adding to the risk of external financing constraints, all 5 countries have elections next year, which will likely raise the political risk, further weighing on the currencies and creating an environment of foreign exchange volatility.
What then does this mean for EM trading? If we take the sentiment that emerging markets are no longer a blanket buy, are we now going to see a separation between good EM currencies and bad EM currencies?
Historically, emerging markets have been bundled together as a uniform group to be sold off during risk-off periods and bought during risk-on periods. And to some extent, this way of perceiving emerging markets changed following the global financial crisis, when investors began to look more at domestic fundamentals. And then came the emerging market sell-off. And even though the EM class was broadly hit, the fragile 5 stood out as the bad emerging market currencies, indicating that investors do in fact discriminate between EM currencies. So I do believe that looking ahead we will see more discrimination. However, that being said, until Fed reveals its tapering plans, emerging market currencies broadly will remain highly dependent on economic indicators external to these economies, such as key indicators from the US.
Is it not also fair to say that many currency crises can be considered self-fulfilling? If we consider the Turkish lira, for example, social unrest in the country triggered a sell-off, which in turn initiated a decline in the currency, causing yet more sell-offs as investors began to lose confidence in Turkey's economy. Which currency do you think could in fact beat these sell-off rumours?
Well, first of all, it's true that currency crises are notoriously self-fulfilling if the underlying economic fundamentals are sufficiently weak. So, for instance, if you have large balance sheet imbalances, this will certainly aggravate any currency depreciation. In Turkey, you have both. You have large short-term external obligations denoted in foreign currency, and so a currency depreciation spinning out of control could therefore be very alarming. So, but I do not see a single winner out of the fragile 5 bunch. Giving a renewed financial shock, all of these currencies are still quite vulnerable. However, judging alone on the size of buffers, such as foreign exchange reserves, Brazil is probably the best position to weather off another sell-off.
And lastly then, Deanie, what would you say then to comments that the bear market in EMs has not yet bottomed? How does Nordea's forecast for the commencement of US tapering shape your expectations for EM performance over the short-term period?
We have not yet seen the bottom. The Fed has not even begun to unwind its monetary stimuli. So, as I see it, the impact of Fed tapering has yet to be revealed. Central banks around the world, both in emerging markets and in developed markets, are navigating unknown waters. But those emerging markets capable of successfully navigating the global tightening will come out stronger and sounder on the other side. Because besides being inevitable, tightening of monetary policies is not an entirely bad thing. First of all, it means that the developed world is recovering, and second, it may facilitate a necessary adjustment in economies in which disequilibria have prevailed due to capital abundance, such as in some of these fragile 5 economies. So, but this is looking at the long term. For the short time period, we expect tapering to begin in January, and they will probably weaken in the short term, of course.
Thanks, Deanie. For a closer look at some of the major currency pairs, click back to Dukascopy TV for Ben Jones' G10 themed Targets in Focus interview. Goodbye for now.